Thanks so much, Roshan, and good morning, everyone. Thanks so much for joining us here today. Before we begin, just like to wish everyone a very good 2023, very blessed, prosperous, and more importantly, a very healthy 2023. So for the next half an hour, I'll just run through what we see as the macro scenario for 2023. Then we move on to the usual sector updates and then the usual stock picks. So I'll just run through this slide. So what we are just saying for our recent report that we released on the 4th was that we are positioning for disinflation. So what we're trying to say is that inflation will be the most important determinant of where the market or even the direction of all asset classes. So what we think is that inflation will be trending down fast, and it's actually trending at around 2.6%, which is quite close to where the Fed is positioning. And you get a bit of flavor to this, I think, on Friday, as you saw the market rally. The market rally, even though because wage growth was just slower by a tad, was a tad slower, and the market started to rally. Having said that, we still think 2023, at least for global markets, equity markets will be better. But just do know that we think that we are still at the matured stage of the cycle. Global growth is slowing down, and likewise, interest rates are still elevated. But we think it's definitely going to be a much better year, at least for global asset classes. I apologize for the date. It's actually meant to be 7th. The picture just depicts that we think that goods prices, rent, supply, services is all starting to drop, like this little raindrop here. The typical disclaimer that we give is, this is purely for educational purposes. We take a lot of data from public sources, and we can't really verify every single public source. And also, do consult your financial advisor for your own financial needs and so forth. We're going to run through what happened in 2022, and I guess the picture kind of explains it. It was the bear took over 2022. Almost all asset classes underperformed. So this slide is just a picture of how the various asset classes perform in 2021, which is in blue, and 2022, which is in orange. So when you start from the left, Singapore did exceptionally well the last 2 years, especially even for this year. So this is in US dollar terms. So you can see that the Singapore equity markets was up about 5% in US dollar terms in 2022. And it was a major outperformer. I mean, if you look at how we compared to MSCI Asia, PAC Japan, the third column, so that represents all the Asian stocks outside of Japan. Very tech heavy. This is mainly your Samsung, Tencent, Alibaba. And you can see that we really, if you add that -20 and 5, you can see that we outperform Asia ex Japan by almost 25 percentage points. And this is huge. I mean, if you're a regional fund manager, one way to outperform was really to have a huge weighting to Singapore. Likewise, we also outperform the US markets, which is S&P 500 and then NASDAQ. You also notice what didn't do well. One of the was bonds, which was down. So these are the bonds ETF. These are mainly US corporate bonds, which is down 20. And you can see the similar performance to the REITs here in Singapore. So because REITs in Singapore is really like a bond proxy. So because of high interest rates, REITs also underperformed was down for the second year. And also just one thing I forgot to mention is that the performance you see here for Singapore excludes dividends. So you can maybe add 3 or 4 percentage points to these returns because we are just using total index returns. On the far right, commodity. So again, commodities was for the second year running the best performer, and commodities also had the impact to equity. So any equity that was linked to commodities also did exceptionally well for the last 2 years. So if you look at so these are some of the major index stocks, and this was the various performance. So if you look on the left, it was another year of resilience for the banks. You look at your upper left. So UOB did well, and do note that in 2021, the banks also had a very good year. I think DBS was up almost 30%, and the rest were all about mid-teens and so forth. So it was another year of resilience for the banks. I think one of the reasons, just to preempt why UOB did better was because we think also because UOB had a smaller presence in Greater China, and because of the concerns most investors have about China, so the preference was tilted towards UOB. I think my colleague Glenn will talk more about it. In terms of the best performance for the index in 2022, it was a lot of names that were energy linked. Why we say that is that the best performer, which was up, was Yang Zhejiang Shipbuilding. My apologies. It was up 95. It was partly also because they did restructuring, so a lot of investors got a cleaner shipbuilding company, and then they shifted out from financial to the shipbuilding, and also because Yang Zhejiang entered into LNG, going to larger energy contract LNG vessels. So actually, their order book didn't really jump that much. It's probably like mid-teens. But what did well for them was because they're moving into LNG, which is obviously the hottest vessel right now because of what has happened in the Ukraine conflict. Others also was energy linked, like Keppel Corp did well because of the restructuring, which my colleague Terence will elaborate more. Because of high oil price, there's a higher chance that the restructuring will happen with Sembcorp Marine, whose order books are up almost 6-7-fold. The worst performance was flat out was just the REITs. So like the title mentioned, REITs were basically crushed in 2022. I mean, your Maple Tree, I think you can see the worst performers are on the bottom right. All dominated by REITs. Of course, one that sticks out is, of course, SETS. SETS was because they were going to do a massive capital raising, and of course, it was downscaled significantly. But when you have a capital raising, if you don't take up these rights issue, your share price can just drop like 20-30%. Of course, this is no longer such a huge capital raising, but that was one of the reasons it underperformed. My final slide for just a quick reflection of what 2022. Again, this is your holiday. This is a currency slide. Also, you can use it for your future destinations, holiday destinations. We usually don't show a currency slide because they hardly move. 2%, 3%. But last year there was a huge move in currencies. So this is the performance of Singapore dollar, and Singapore again was a beacon of strength in 2022 compared to the other countries. So when it positive means Singapore currency appreciated. So we were roughly flat against the US dollar, but against the big G7 currencies like your euro, the British pound, we were massive outperformers. So again, if you are a region, and of course we were also one of the strongest in Asia against the Chinese renminbi, Indonesian rupiah, and also Malaysia. So the currency is also another important strength, I think, for flows and so forth. So we only have 3 slides to review for 2022. We won't, again, as usual, won't dwell too much on the past. So we will start off with just what we see is the macro landscape or macro trends or themes for 2023. Before we begin, I think we want to reflect what were some of our predictions that we did for 2022, whether it went well, and these are our predictions for 2023. These are purely macro predictions. X means we got it wrong, so please don't look at those. Look at focus know where we had the tick. So tick means we got it right. So for 2022, what we forecasted wrongly was we thought inflation was going to peak, and we thought the supply chain was going to ease, which didn't happen. We were right for vaccines. I think we were very good armchair doctors, I think, sitting in office and becoming doctors to talking about the vaccine and the virus. So we got that right. The one that we did terribly wrong at least in the beginning of the year was we thought interest rates was going to be modestly higher. So when we entered 2022 or early last year, I think most of the market participants were expecting like maybe a 1 percentage point increase or 0.75 increase in interest rates by the end of 2022. But instead, we got 4.25%. So instead, interest rates spiked up by almost 4 percentage points. And that, like we said, hurt REITs, hurt valuations, hurt bonds, hurt almost all asset classes. Then on the 4th point, we thought there were rebound in tourism, which of course we kind of got that right too. So in terms of 2023, some of the macro themes will be, we think inflation is going to peak with possible rate cuts. A bit aggressive, although it's a bit more on the speculative front. We think the recession in the US will be mild, and also interest. And also there'll be a rebound in China, and also the tourism will recover in China. So in terms of the first theme, will be a falling inflation rate. So that's the most critical theme that that needs to happen for the markets to directionally for the markets. So why we think inflation would come down is because if you look at goods inflation, which is if you look at PPI, so PPI is basically the cost for manufacturers. So what we're saying is that manufacturing costs is coming down, the red line, and this will usually drag. This has a very close link to CPI. So we still see there's a lot of room for core PCE, which is the Fed's favorite indicator for inflation to come off. Then the most stubborn part of inflation right now in the US, all of us have to look at inflation in the US because that's going to dictate the global monetary policy. That's why we are all focused on the US. So one of the other things that's happening is shelter, which is the major component of inflation. I won't go too technical on this, but basically rents in the US is coming down, and we think it will eventually drag down CPI. So this is another pressure point for inflation, which if inflation comes down, is going to be very good for the markets because it will cause a pause and even a rate cut by the Fed. Then in terms of the logistics cost, so logistics is collapsing very sharply. This is the container, so all of deliveries from Taobao so far should be coming off because container rates are almost coming back to pre-pandemic levels. So this is a chart of what it costs of a container you move from China to US or China to Europe. So you can see it spiked from maybe 2,000 to 15,000, and then now it's back to almost to the 2,000 level. So this will be another pressure point to keep inflation lower. The other thing that we look at is also money supply, and that's also coming off. So that's also another good sign. Again, it doesn't account for the euro dollar, which is another pool of liquidity, but at least for domestic liquidity in the US, it's not expanding that much, and that will also kind of placate inflationary pressures. So this is the prediction. So this is where what the market thinks in terms of interest rates. So for 2023, the market thinks that there will be another 50 basis points hike. So interest rates is expected to climb another 50 basis points because of what the Fed is guiding. And by the end of 2023, there's also possibility that there will be a rate cut by 25. But for us, we think we are a bit more aggressive. We think there is a possibility, although it's a bit speculative now, that there could even be a rate cut by 2023 if inflation really collapses as we think it will. I think we probably could trend to even below 3% based on the current inflation rate. But having said that, do know that interest rates will come off, but it won't collapse back to the usual 2%, 3%, that help all the REITs to rally. Because if you look at this chart, so the blue line is basically interest rates, and the red line is inflation. So usually the Fed needs to have a real interest rates. I mean, for those what we are trying to say is that you need to get a real return for the interest rate. So you can't be paid FD 4% and then inflation 6%, then it's like negative. So for the Fed's point of view, they always want to keep the blue line above the red line. And that's why it's going to be, although inflation will come off, but you won't see interest rates drop back to in the past at 2%, or obviously not 0, but not even 2 or even 3%. But it will be tapering down, but it won't be like collapsing because they will still want to keep. They need real interest rates. The other theme that we see will be a softer US recession. I think this is the most famous chart. So this is the yield curve. Just to rewind for those who may not be clear what the yield curve, instead of using bonds, so this is like instead of using a 10-year bond, so this is like your 10-year FD rate versus the 2-year. So what they're trying to say is that if your 10-year FD rate is actually lower than your 2 years, which shouldn't happen. I mean, if you're keeping your money longer, you should be paid more. It has been a very good indicator of recession. So whenever that goes negative, you can see that it will invert or it will go negative just before the inflation, which is the beige line colored. The only reservation we have right now is that of course this is a very good indicator, very consistent indicator of a coming US recession, but it doesn't tell us the depth nor the timing. And the only difference we think right now is that the last 40 years we didn't really have inflation. So this might be a bit, the signals here might be a bit more mixed because it might be showing that inflation might be coming down. I'm sorry, I'm probably going to confuse a lot of people, but this is just one of the how we view the yield curve, because this is one of the most talked about indicators out there. But it does still point to recession coming in the US. Again, this is also another indicator of manufacturing activity. When it collapses, you can see that it collapses during a recession. So speaking to some exporters, what we think the conditions right now in general for manufacturing is that in 2020 and 2021, because of the pandemic and because there was a lot of shortage of goods, so a lot of retailers and wholesalers in the US imported, like over-ordered and they double-ordered. And right now they just have too much inventory. So there's just too much inventory in the stores. And right now in the US, they are trying to work down all this inventory. So this is also can be a trigger to recession, because what it means is that if the factory, if the shops are all full of goods, then the manufacturers here in Asia don't need to produce so much. Then this will kind of dwindle down activity. And this also can be a trigger. But that is, in general, broadly speaking, if you speak to most manufacturers, this is the current conditions right now in the US, if you have a US customer especially. The other thing why we are not so worried of a US recession is because it is in a way kind of priced in, especially in the bond markets. But again, this is the Google search term for recession. So the number of people talking about recession is as much as when we had the last huge recession, which is the global financial crisis, and of course even the pandemic. So in a way, we think recession is really, kind of priced in the market because everybody knows about it. Everyone has been talking about recession. So that kind of like downplays our fears of a recessionary impact on the equity markets, especially in Singapore. So just one last point here. The other reason why we think the inflation is going to be mild in the US is, of course, if you go a bit more technical in how they define recessions, it also needs to take into account the employment situation in the US. So the employment in the US is still very robust. I think yesterday's figures, the US added about almost 220,000 new jobs. Even this is even better than pre-pandemic, about I think 160,000. So the labor conditions in the US is still very robust. Unless it collapses, then only you can probably tag it as a recession. The other thing to note, just to go back to this chart, is that our nominal GDP, that means nominal GDP, you can think of it like cash flow for the economy, is still very strong. It's just that from an economist point of view, again, sorry, this is a bit technical, but for economist point of view, they measure recessions, I think, taking out inflation. But in terms of the general economic conditions, you can see from the blue line here that in 2023-24, it's still going to be very robust. We are looking at maybe GDPs similar to 2014, 2011. The major contractions where actually cash flows contracts, if you use nominal GDP, is only in like global financial crisis and in 2020. So that's why we think the recession conditions, even if they do tag one, to be very mild because we are in a nominal GDP, we're still going to be very strong GDP growth in the US. Of course, as an equity investor, the most important for us is about earnings. So the table on the left is how was corporate earnings during recession years. So because of the last 3 years, when there was a recession, US corporate earnings dropped about almost 20%. And that's what is the fear for most investors now, because if you go into recession, earnings are just going to collapse 20%. I think the market expectation is about 10% growth. But if you look at the inflationary years from 1970s, the three recession from 1970 to 1980, why we use this period is because those was when this is because the inflation now is back to 40-year high. So this is quite a similar conditions, and you'll notice that US earnings doesn't really drop that much. On average, maybe 3%. So we think the US earnings in the US won't collapse so much because we are in the inflationary period. I think my colleague Jonathan will dwell more on the US markets, but we just wanted to, because now US, what happens in the US has major implications in Singapore. So that's one of the reasons why we went a bit more deeper here, and I think probably might confuse a few people, but basically what we think is that even if there is a recession, the earnings won't collapse as much if you use what has happened in the 1970s. This is just my last slide. because we do sometimes get questions on Bitcoin and crypto. So this chart basically shows the red line is basically a Bitcoin, and the blue line is basically negative yielding debt. So when there was a lot of negative debt, if you recall, in Europe they were issuing negative interest rates. So if you bought into a European bond, you actually have to pay them money rather than they pay you. So I guess what we just learned is, I think, you I guess can get rich printing your own currency, but then just don't leverage on it. But we won't delve too much, but I guess we just follow the mantra of the MES. This is not a medium exchange, it's not a store of value, and neither is cryptocurrencies a unit of a unit of account for accounting purposes. So this is the MES stance on crypto. So we just wanted to just reflect that. We get back to something easier, which is the Singapore economy, and the Singapore economy is very robust. So if you look at retail sales in Singapore, we are expanding at 9 times. So retail sales in Singapore is growing 9 times faster than pre-pandemic. So retail sales in Singapore during the pre-pandemic years was probably growing like 1% a year, so hardly anything. So right now, the latest numbers, retail sales is growing on a moving average about 13%, on the latest number 9%. So the retail scene in Singapore is still exceptionally robust, and we think it's a reflection of the strong domestic economy here in Singapore. And the reason why, of course, firstly, wage growth in Singapore is exceptionally strong. I think we are having this is based on the data contributions to the CPF. So wage growth in Singapore is growing right around 7% annualized, and this is the fastest in 15 years. You can see from the red line. Another reason why the economy is strong is because there's ample jobs here. So the blue line and the red line is basically the vacancies. So you're talking about vacancies about 100 over 1,000 in Singapore. And in terms of the ratios, that means the number of people number of openings to a person who's looking for a job, you're looking at about roughly about 2.2. So this is the best since the good years of 1996, 1997. So the employment conditions in Singapore is exceptionally robust based on the data. We do get a lot of questions on this. So this is the household wealth. We don't compute this. This comes from the Department of Statistics. So the household wealth in Singapore is also growing about 7%. A lot of it is, of course, due to property. So inside this net assets is the amount of currencies held by individuals and households in Singapore, financial assets, but it's growing about 7%. So again, the household net wealth in Singapore is still growing and still robust. Of course, property did exceptionally well and it's up 70%. Finally, one of the reasons why Singapore is doing well is we are getting flows. We're getting like almost a huge, like almost 100 billion of foreign direct investments into Singapore. We are bigger than all the 5 ASEAN countries combined, Indonesia, Malaysia. So this is one of the reasons for the strong job and also the vibrant economy in Singapore. It's not back to the record levels of maybe 110 billion, but again, 100 billion is still a very strong number, considering that borders are closed, and we can only assume that if borders reopen, this could actually reinvigorate investments back into Singapore. And of course, tourism is fantastic. I think if you run a hotel now, it's one of the best rates ever. I think my colleague Darren will dwell more. So room rates in Singapore is the best, it's the highest on record. And if you add that into occupancy, you're looking at $240. Again, this is far higher than pre-pandemic, like almost 20% higher than pre-pandemic. And if you get China reopening, you can only assume that this is just going to go to record levels in terms of revenues for hotels here. There's 2 final slides for Singapore. The economy in Singapore is robust, and also valuations are attractive. So this is the PE. Expectations for 2023 is that earnings growth of about 13%, and our valuations is about the lower quartile, which is below the. So what you can look at it is that whenever it goes below that orange line, the 1 standard deviation, it tends to bounce back up. So hopefully we get a valuation expansion in Singapore, and that could help the stock market here. Of course, we cannot look at valuations for Singapore in isolation, considering right now of course, the interest rates are higher, then of course, you make equities less attractive. But if you take the valuations, if you include valuations into the higher interest rates, valuations are still attractive. It's still at average levels. It's not at the lower quartile, but it's around the green level. So valuations is a bit more complicated here. We take earnings yield, which is the inverse of PE minus. Sorry, I mean this is a bit complicated, but basically we're just taking into account PE and then we adjust it out for higher interest rates and we see how is the earnings. So even after taking out the higher interest rates in Singapore, equities look attractive valuation wise. So this is going to be our last theme. I mean, we had to add it because of what happened in China. So China reopening, we need to emphasize, is very, very critical for a lot of corporates here in Singapore, especially from a bottoms-up approach. So if you look at banks, so for the banks, we have a lot of loan and property exposure to China. We had a bit of a scare for UOB in terms of property collateral. So if China reopens and the economy recovers, it's going to be very good for the banks, especially DBS and OCBC because of their larger exposure to Hong Kong. It's going to help Wilmar because they got branded oil, they got soy grill, DFI, because they got groceries, they got alcohol. So almost 3/4 of all the listed companies on the index have exposure to China or China reopening. Even the telcos, because if China tourism come in, then you're going to get a big boost in roaming, which is and China is the second largest market. Of course, we got transportation, Comfort because they have taxis there, SATS, SIA. So the China reopening is going to be a very big boost for 3/4 of all the stocks here. Not to mention the already strong local economy here, and this was just going to be it was like I guess a Christmas present in a way for a lot of the corporates here. If Singapore, if the Chinese economy rebounds strongly. My final slide is just it's a very more of a thematic thing. So the blue line basically is the imports for all the 5 largest economies in the world. So you can look at this chart as aggregate demand. So the worry we have into 2023 is because Europe is going to recession, then US is slowing down. So it will pull down global aggregate demand. That means the whole global economies demand will be slower. So you can see that global demand was trending sideways a little bit until we had the pandemic, and then because of all the stimulus by government, it spiked up. China didn't do well, but what we're just trying to say is that if you see the RMB strengthening, this is going to be a very big boost for global economies. Because if RMB strengthen, it will strengthen the purchasing power for a lot of Chinese consumers, and this is going to help the whole global economy. It's something to monitor. I mean, just a talking point, but it's something for investors to monitor. Okay, I think enough for macro. I apologize. I know sometimes we might go into a bit more technical. So apologize if some may or may not understand. So because sometimes it's very hard to explain these terms. But anyway, we're going to something easier for more relevant, I guess, for everyone. I'll hand it over to my colleague Zain, who will take over control and discuss about his technical views. Zain, over to you.
All right. Thanks, Paul. So now I'll be covering the technical analysis section. So let me just control the screen. Okay, so for this section, I'll talk about first the outlook of the STI and then followed by our large cap pick as well as our mid cap pick. So for the Straits Times Index, it looks like it's currently still undergoing some consolidation for potential breakout this year. So just to recap, in 4th quarter last year, what the STI did was that in October, we had a sell down to about just below the 3,000 level to 2,970, where we met the key uptrend support line spanning from dating back to the COVID bottom in 2020. It was supported and then we subsequently rebounded back to near the 3,300 level. And then from mid of November onwards, we kind of consolidated around there till the end of the year. So for this, for 1st quarter 2023 wise, I would expect possibly we are further consolidation in the index. Further consolidation in the index as we are still facing quite a lot of resistance in this resistance zone 1, which is at about 3,230 to about 3,330 points level. And we also meet 2,000 two trend channels, where the first one is this blue color trend downtrend channel over here, where there's a resistance acting on it, as well as another trend channel in black over here as well. So with a confluence of resistance over here, it could take some time for the index to break out the key 3,000 to 3,330 level in the future. Following a breakout if we do get a breakout in the future wise, I think we could hit to the next resistance zone at near the 3,400 level, which is where we can meet this trend line resistance over here, and then the two swing, and then as well as it meets the swing highs generated in early last year as well. The key support zone for the STI is near the 3,000 to about 3,100 level, where we found mainly support last year in this green box over here. So from a weekly point of view, overall wise, the index is still looking good with a potential bullish inverse head and shoulder pattern potentially forming out. So for this quarter, we could just take some time to form the right shoulder of this bullish pattern over here. Next, I'll move on to the large cap pick. So it will be CapitaLand investment, Capital Integrated Commercial Trust, my apologies. So for CICT, since the sell down took us to about $1.74 in October last year, we have started to move back inside this downtrend channel over here, and we have started a short-term uptrend over here, as you can see with the higher highs being formed, as well as the higher lows being formed over here. So currently, we are at the downtrend channel resistance over here, where we are currently forming a bullish pennant in progress. So given if we do find some support at the support zone near the $2 level over here, this green color zone, we could actually see a breakout in the future if we do break out over this bullish panel over here. So if we take the height of this panel, which is about 15 cents over here, and we project in onto a possible breakout point over here near the $2.05, $2.06 level, we could achieve a possible target of about $2.20, where this will be confirmed with a previous swing high levels back in May to July last year over here, as well as the 78.6% retracement level at about $2.18. So this brings us to a potential target of about $2.20, about a 10% upside from the current price levels. So for the mid-cap pick wise, it will be Food Empire Holdings. So for this company, it's a manufacturing company that deals with F&B, such as your instant beverages and your frozen snack products. So for Food Empire wise, this mid-cap stock has been trending rather well. It has been in this, there was an uptrend channel forming over here all the time since last year, since March last year. And then we actually broke out of this uptrend channel over here, where we are currently in this bullish pennant over here. So when we take the height of this bullish pennant, that's about 6.5 cents. To we project it to a possible breakout point near the 66 cents mark, we actually get a target of about 72.5 cents, which is a possible 10.7% upside currently. So if the stock managed to break out of this bullish pennant, we could see a target of about 72.5 cents. That is confirmed with this trendline resistance over here, which dates back to about 2021, quite a strong trendline resistance, as well as where it meets the resistance zone over here in a red box, which is the prior support level back in 2021, the last quarter of 2021 over here. So this is a bullish pattern that's forming outside this uptrend channel that's worthy to watch out for. So that's all from me for the technical analysis section. I'll now pass on my time to Glenn to talk about the banking sector trends.
So thanks, Zain. So for the sector trends, we'll start off with the banks. So for the banks, looking at this chart, we can see that the interest rates have actually spiked. in line, the interest rates have resulted in a spike in the NIM. So our NIMs is, if you look at this chart, is the red line there. Well, the interest rates are the blue line, so the dark blue and the light blue. Light blue would be the SORA, while the dark blue would be the SIBOR. So this is mainly due to the Fed rate hikes in 2022, which were the highest on record. And these hikes actually total 425 basis points in FY22. And this resulted in a similar move in both the 3-month SORA as well as the 3-month SIBOR to 2.69% and 3.99% respectively. So this represented 253 basis points increase for the SORA and 355 basis points increase in the SIBOR. So it's a year-on-year increase. So what does the SORA and the SIBOR mean? The SORA stands for the Singapore Overnight Rate Average, and it's the volume-weighted average borrowing rate in Singapore's unsecured overnight interbank cash market. While the SIBOR stands for the Singapore Interbank Offered Rate, and is what the bank estimates it will have to pay another bank to borrow Singapore dollars. So based on historical data, it shows that there is a strong correlation between the US Fed's funds rate and both the SORA and the SIBOR. Hence, if the US Fed funds rate goes up, the Singapore interest rates are also expected to increase in tandem. As a result of the US Fed rate hikes, as well as the subsequent increase in the Singapore interest rates, the bank's NIMs have increased by 44 basis points from 1.53% in the first quarter of 2022 to 1.97% as at the third quarter of 2022. And this is seen with the red line here. So while the net interest income has also surged by 42% year-on-year in the third quarter, however, the higher NIMs were slightly offset by the moderating loans and deposit volumes and lower fee and other non-interest income. And this is mainly due to the weaker market sentiment, as customer activities were more subdued amid a risk-off investment sentiment globally. And the decline in fee income was seen mainly in the wealth management as well as investment banking segments. But this was offset slightly by an increase in credit card fees as the borders start to reopen and increase spending, as well as an increase in their loan-related fees. So for comparison for the NIMs, the pre-COVID NIM growth was actually quite stagnant. So in 2019, NIM was quite flat and the net interest income only grew 6% year-on-year, while in 2018, the NIM only grew 2 basis points and for the same period, and net interest income grew 13% year-on-year. So now moving on to the next slide. So this is the 2023 outlook, and we'll take a look first at the loans growth. So if you look at this chart here, we have plotted 4 segments of the loans growth, which are the most significant, and the first one being financial institutions, housing loans, building and construction, as well as the total loans line. So amongst the various loan segments over the past 4 years, we can see that the financial institution segment was the fastest growing. And we believe that bulk of these loans were for commercial property acquisitions, especially for the REITs. And the 3 local banks combined loans to the FI segment, or financial institution segment, it grew by 25% in 2021 to 103 billion, and at a CAGR of 7.7% over the past 3 years. And this outpaces the total loans CAGR of 4.3% over the same period. So for comparison, we look at the housing loans, which is the blue line, as well as the building and construction loans, which is the green line. The housing loan segment grew by 4.4% in 2021 and grew at a more moderate CAGR of only 1.2% over the past 3 years, while the building and construction segment grew by 13.2% in 2021 and grew at a higher CAGR of 7.9% over the past 3 years. However, these two is still lower than the financial institution segment. So these 2 segments are quite significant because the housing loan segment is the second largest loan segment, making up about 21% of FY21 total loans, while the building and construction segment is the largest loan segment, making up 27% of the FY21 total loans. So with Singapore loans growth ranging from around 2 to 5%, and with limited areas to grow in Singapore, we do expect that the segment with the most potential would be the FI segment, with loans mainly to the REITs. Having said that, the largest stress in the loans portfolio is also possibly from the FI segment, as it was the fastest growth category. Anecdotally, we do observe stress in the commercial property loans to listed companies with exposure in emerging countries such as China, Malaysia, and Myanmar. So while if you look at the last plot here on the bottom axis, we can see for the first half 2022 figures, there was a slight dip in the growth, but the FI segment still remain as a segment with the highest growth. So for other points of the 2023 outlook for the finance sector, both the 3-month SORA as well as the 3-month SIBOR have reached record highs in FY22 from record lows in FY21. And we expect that the interest rates will continue to increase until the second half of 2023. Market expectations are also for the Fed fund rate to exceed 5% in FY23. And 100 basis points move can raise our earnings by 10 to 15%. As such, the NIM guidance for all three banks have been increased, and they're also expected to continue its growth until the second half of 2023. This is mainly due to the continued interest rate hikes, which are expected to last until the second half of this year. However, this higher NIM as well as net interest income would be offset by slower loans growth, which is now at a mid-single digit guidance, and lower fee income, mainly due to the weaker market sentiment globally. And the banks have guided for NIMs of 1.75 to 2% for full year 2022, and to surpass these levels going into the first half of this year. So that's all I have for the banking sector. I'll now hand it over to Darren for the REITs. Thank you.
Yeah, thanks, Glenn. So for the REITs, before we go into the 2023 outlook, let's talk a bit about what happened in 2022. So in 2022, basically the interest rate shot up to about 4% for the Fed funds rate, which this definitely bettered all the REITs. So the REITs, the total return as a result was down about 10%. And the hospitality sector was the only sector that was actually in the black. The other sectors all came in negative. So the hospitality sector came in at about 5.4% positive return, while the worst performer was actually the commercial sector, which was down about 24%. So in 2022 as well, with the high interest rate environment, inorganic growth was really challenging because the cap rates were kind of maintaining around the same levels while the interest rates were spiking up, making any accretive acquisitions very challenging. So this will be the same situation going forward into 2023. So for 2023, any inorganic growth will also continue to be a challenge. However, in 2022, we saw some accretive acquisitions mainly in Japan, because Japan, the yields there is still, the cost of borrowing is still very low at less than 1%. So you could still get some accretive acquisitions down there. So going into the outlook for 2023, let's look at this chart. So this chart is actually the SREIT dividend yield spread over the 10-year Singapore government savings bond. So how you can read this is how much dividend yield are you getting for the REITs when you invest in them over the 10-year risk-free rate, risk-free interest rate bond. So you can see as you invest in a fixed deposit and you get maybe 3%, and if the dividend yield spread is 5% and if the dividend yield is 5%, you get a spread of 2%. So we can see from here in 2022 is trading now at around negative 1.6 standard deviation. So this is very expensive, but the yield spread is so low mainly because of the spike in the 10-year Singapore government savings bond rather than a decrease in the dividend yield of the REITs. So just to mention that the red line is the mean and the green lines are the plus and minus 1 standard deviation. So you can see this is at these levels at minus 1.6 standard deviation, it is the 10-year, almost a 10-year lows, bearing in mind the 2022, the small dip recently. So just another note is that last year, last quarter we were underweight on REITs, but this quarter we kind of upgraded it to neutral because of a few factors. One of it is we think if there is a mild recession coming in the US going to 2023, dividend yielding stocks in Singapore, a lot of the investors will want to pile back into this dividend yielding plays. So over time, it might not be first half, maybe in the second half, investors will start to re-enter all these REITs as they are seeking dividend play and kind of a safe haven compared to the a recession shelter, rather, to put it. Another reason, recently, Manulife US REIT, at the end of last year, they issued some news that there was a devaluation of 10.9% of their portfolio value. But this 10.9% is actually half of it is this asset called Figura, and it really was the main thing that put down the portfolio. The other assets were down about from single digit to 12, like maybe low, like 2% to 12%. So the big one was a 33% devaluation of Figura at Manulife US REIT. So we see this happening to some of the other REITs as well. It's inevitable that the REITs will experience this devaluation because of the rising interest rates, which means the discount rates used will be higher, and the exit cap rates used also are higher. So, but we do not see such a great impact because the like the Manulife, we saw such a big impact of the Figura, but for Prime US REIT, we see like maybe a a mid-single digit, around 4 to 6% devaluation in the portfolio value instead of upwards of 10%. So that is also a headwind as we see the devaluation of all this property value. Yeah, next slide, please. So just now that slide was the SREITs index. So this is the individual stocks, their dividend yield spread. As you can see, some of the ticker names like CLAS is the new ticker for CapitaLand, Ascott, and CLAR is CapitaLand Ascenders REIT. And we have some other names like Keppel DC, CICT, Fraser Centrepoint Trust, and Fraser Logistics and Commercial Trust. So as you can see in the red box, the dividend yield spread is actually around the same levels for some of the local REITs, but for Prime, the dividend yield spread really shot up to upwards of 14%. So because of this, we think Prime is one of the our topics, as it definitely, as seen from this chart, has priced in all the interest rates and uncertainties, as the yield spread is now at about is upwards of 15%. Yeah, next slide, please. Yeah, okay, so this chart is actually the SREIT index price return versus the 10-2 the bond spread. So the orange line is actually the US 10-2 spread, 10-year government bonds minus the 2-year government bonds, and the Singapore is the 10-year minus the and the gray line is the Singapore's 10-year minus 2 years. So as you can see in this red box, there is a slight negative correlation, as when we see the spread narrowing or heading towards zero in this red box, we see that the price return of the SREIT actually is going upwards. So normally when we see this 10-2 spread narrowing, we see the economy is kind of projecting that there is a slower growth as the further interest rates, the yield on the further bonds on longer dated bonds are lower than the nearer dated bonds. And then if you believe in this theory that there is kind of a negative correlation, then going forward, as you can see, the yield spread is actually inverted in December 22, and going forward, we think that there actually might be another rebound in the REITs if we follow this theory of negative correlation. Next slide, please. So this chart is actually the valuations of some of the REITs. So over here in this scatter plot, there are about slightly more than half of the REIT universe that are in here, because I did put all the REIT, because it will be too messy. There are just too many REITs. So you can see on the left side is actually the price to book, and on the horizontal axis is the dividend yield. So we noticed that a lot of the REITs are scattered around the 4 to 7% dividend yield and about 0.8 to 1.2 price to book. So they're all scattered around the center. Those are the local REITs. But then we see some like high dividend yield plays. Most of them are the overseas REITs, like the REITs with overseas assets like the Manulife and Prime and Cromwell and Elite. Those are trading above 10% yield, and their book value is also around 0.5% and lower. And so we see it as the bottom right hand side is cheap and the top left hand side is expensive, because they are, like for Parkway Life REIT, their dividend yield is low, about 4%, and they are trading at a high price book ratio of about 1.5%. Yeah, so look at this chart, we see that the overseas REITs seem to have pricing risk and are cheaper in comparison to some of the local REITs. Yeah, next slide, please. Yeah, so of all the SREITs, we favor the hospitality sector in 2023 because of the recovery in RevPAR. Paul mentioned a bit about it earlier. So you can see November 22's RevPAR is 20% above November 19 levels, over 20% above pre-COVID levels. And the visitor arrivals are still 45% below November 19 levels. But with the China reopening, we expect these visitor arrivals to shoot up. And when this visitor arrivals shoot up, the RevPAR will definitely continue on the upward trajectory. So going forward, we still favor this hospitality sector over all the other subsectors of REITs. Yeah. So with that, that's all for REITs. I'll hand over to Terence.
Yeah, thanks, Darren, and good morning, everyone. For the construction sector, the key thing we are watching now is the heightened alert that was implemented by the Ministry of Manpower, MOM. So what happened was, because of the spike in accident cases in the construction site, there are a total of about 57 fatal accidents at the construction site in 2022. So in September, the Ministry of Manpower actually implemented this heightened alert for all the construction sector. So what this heightened alert does is that when this heightened alert, which will last until from September of 2022 until the first quarter of 2023 until March, is in place, this 6 months period when it is in place, it means that the construction sectors need to observe a safety period every week. So every week they need to brief their workers on safety. They need to make sure that they are trained in workplace safety. What happened is that the inspections during this time will also climb up during this time. So they're doing more frequent inspection of the construction site during this heightened alert period. And if they find these MOM officers find any breach in the safety regulations within the construction site, then they can impose penalties on the construction site. Some of these more punitive penalties are like, it could be a 1 week stop work order. Even if you chalk up many offenses, there can be a 2 week stop work order, even extending to 1 month. So that will affect their whole entire construction progress and also affect their overall workflow. So for that reason, you can see the contracts awarded in the construction sector also coming down. If you look at the chart here on your left hand side, you can see this blue line here is the contracts awarded based on the latest 10 months 22 that we have. You can see the 10 months awarded has actually come down. Overall for 10 months 22 is down 9.4% on a year-on-year basis. But one positive thing is this orange line here, the progress payments. If you look at the October 22, you can see that progress payments are actually trending ahead of contracts awarded, which means that the construction companies are still making billings. What this progress payments is, when you complete the work that you do, then you can actually do progress billings from your customers. You can actually bill your customers and collect payments. So you can see progress payments is trending up, but obviously the construction contracts awarded is down mainly because of this heightened alert. So we remain cautious. Our view is that we remain cautious up to first quarter of 2023 because of this heightened alert in place. But overall, when we look at the construction demand forecast, especially the forecast by the Building and Construction Authority, you can see that for 2022, they still expect about 29 to 32 billion. This is upgraded from 27 to 32 billion previously. And then for 2023 to 2025, the demand forecast also continue to remain very healthy. If we take the midpoint about 29 to 30 billion dollars. This is comparable and very close to the MBS when they're building the integrated resorts, the higher, it's about 35 billion. So you can see this largely in line. But even when we look beyond the integrated resource period, when construction demand was exceptionally high, this is already higher than the average construction demand pre-COVID. So the construction demand outlook is positive. And this demand outlook is really supported by the high number of BTO flats, right, that they actually launch in view of the demand for BTO flats. So we are overweight on the construction sector. In our next slide, on the utilities sector. For the utilities sector, the spark spreads remain elevated in third quarter of 2022, even though it declined slightly after June, but it rebounded in October and November 2022. So we back up a little bit, right? What these spark spreads mean is how you compute it is you take the difference between the USEP prices in Singapore, which means the uniform standard electricity price in Singapore, the price that consumers pay for electricity, and then you take out the high sulfur fuel oil, which is the cost of generating this electricity, then you get the difference, which is the spark spread. So essentially, another way to look at spark spreads is the profit that Gencos make on generating electricity. And you can see that since 2021, the chart here is a little bit small, I apologize. But you can see since the third quarter of 2021, we already see a spike in the spark spreads. And this was driven by the strong global energy demand in the third quarter of 2021. And this persisted through 2022. Also the elevation was because of the Ukraine war. But then after that, in June, the second half, it obviously moderated. But October and November, we saw a rebound as well. So so for us, this provides a lot of support for the Genco profits in 2022. And even for the first half of 2023, we continue to see spark spreads remaining elevated. And so we are positive on the sector for 2023. In my last slide for sector on the air transport industry, for us, the biggest, most obvious tailwind for the air transport industry is the easing COVID restrictions in China. So based on the latest month that we have available, November is already at 75% of pre-COVID levels. When based on the data that we have on December, we don't have the full month December yet. That data is not out yet. But the first week of December, they are already at 82% of pre-COVID levels, and that's before China even eased their COVID restrictions. So we think the easing COVID restrictions will be a key theme and tailwind for the air transport industry in 2023. So the air transport players already guided that their second half financial year, they expect to break even by December, and they expect to also be profitable by the next financial year, which is FY24. So recall that their financial year is March. So after March, they expect to actually turn around already. So we are overall, again, we are overweight on the air transport industry. So that's all from me from the air transport industry. I will hand over back to Paul.
Thanks, Terence. So I'll move on to land transport, which is essentially just one stock, ComfortDelgro and SBS, where there's hardly any volumes. But anyway, just for land transport, what we see is on the left is basically rail, MRT. Basically, you can see the volumes for MRT is exceptionally strong for SBS Transit. It is up about 55% year on year. And the other positive is that there's going to be a price increase. I think it was effective December. But all of us don't have to pay, because I think for passengers, you're only going to pay roughly around 3% higher. The rest of it, the government's going to subsidize. So this is a positive for Comfort because volumes are up, and of course price is also up. And because for rail, they collect the revenues belongs to them, whereas for bus is more like a service. So this is going to be a positive for Comfort. On the right is a P2P trip, which is point to point. Basically used to be called taxi, now they just call it P2P. So the red line is basically ride hail. I mean, all your Grab or Grab Gojek and of course Comfort ride hail. So that is doing well. So that is up about 16% year on year. Now overall taxi trips, overall ridership P2P trips is up 10%. Street hail is down. That means people standing out there calling hailing a taxi. That is obviously down. So this will affect Comfort, but what they have done is that they actually changed the model. So they are used the app that they are using. They're going to charge now. So they're trying to pivot towards more the ride hail. So they actually charge, I think, 5% commission for those who use their app. So those who do the ride hail, whereas for Grab it's about 20%. So this pivot is important for Comfort so that because the growth is coming from ride hailing and nobody goes on the street and call a cab, I mean, or less people. So this is a very good transition for them. But that's the conditions right now. So taxi volumes are up and also rail volumes are also up. For property, we just have one slide because probably most on the call are already the property experts. But just to recall on this whole cycle, so after the GFC, we had a magnificent rally. Everybody queued to buy property. Then until TDSR came, then nobody went out to queue for property. Then there was a slight relaxation of seller stamp duty. Then the market rallied in 2018. Then government came in again. After one market rallied again, then government came in again last year, but market still rallied. So our post-cooling measures, the most recent where they raised ABSD and TDSR, the market is still up. So there's good and bad news. The good news is, of course, the market is very resilient. I think like the AMO, there was the number of checks, probably the whole property available was about, don't have the exact number, 200-300 units, but the amount of checks out there is probably like 1,000. That probably cooled down, I don't know, maybe a couple hundred, but it's still very robust. The worry is actually the market might be just too hot. So we worry that anytime it crosses 10%, the cooling measures might come in. Why the market we think will still remain vibrant for next year is because there's still lack of supply. I think the overall market is probably only 1.5 years of supply, usually 3 years. And in the OCR, outer core region, the mass market, it's only 0.5 years of supply. So one of the reasons is lack of supply. And of course, the other reason why the property market is strong is because it's a very vibrant resale market. And because when you're sitting on profit, so for HDB and so private, so that's helping generate equity and a lot of upgraders. So next year we also have a buy for PropNext also because we think the volume is going to spike back up for next year, especially for new launches. Healthcare, this is IHH. So most of because Raffles doesn't give any data, the only one that thankfully gives operating data is actually the Malaysian listed IHH, not own Gleneagles, the Parkway Group. So what you can see from here is that in the third quarter, this is the revenue per patient. Okay, doesn't mean people are getting more sick. You can see that it jumped from 36,000 to 48,000 ringgit. It's just that there's more medical tourism, and this is a big jump. So you're talking about 40% jump. So what has happened in healthcare, especially for hospitals, just 2 points is that after they lost COVID revenue from testing, vaccination, medical tourism came up, and you can see that's why the volumes are flat, the blue line, but you can see that the revenue per patient, inpatient, those who had to be admitted, sadly, but those actually jumped very strongly. And the other point to note is that although hospitals are trading with 20-30 times PE, there were 2 proposed deals early this year. If you read our report, there was a KKR wanted to buy Ramsey in the US for almost 50 times PE. IHH also wanted to buy something in Malaysia for hospital, also 50 times PE. So hospital stocks will trade high because even privatizations were done like 20 plus times PE. So what we're just trying to say is that don't expect hospitals to be cheap. They will probably trade above even 30 times 40 times is also a possibility because some of these M&A transactions are going at these areas. So we also still like Raffles Medical. I think they did really well, but the key for them is how well are they going to operate out of China. Then for semiconductors, our electronics, so we are in the downturn phase now. So the typical cycle, you see the arrows, the up cycle in semicon can be 19 months, 29. The most recent was a bit more elongated, 32 months. So right now we're in a down cycle. So the downturns can last from 12 months to 28 months. I mean, pick your date, you can choose any. But we think this downturn will probably last until end of this year. So it's going to be a weak condition for semiconductors. Some of the reasons why the end demand is weak, especially memory. I think memory has been one of the so if you look at the chart on the left, so this is PC, your computers, your laptops, and so forth. So during the pandemic, might be a bit small for some of you, but if you look at the 2020-21, you can see that PC demand was very strong because of the pandemic. Everybody wanted to buy, and I think all of us start at home, so all of us started to buy computers, and demand just spiked up 26% per year. Then 2022, it contracted. It fell back down 17%. So it went up and then it collapsed back down. And that also, of course, caused a lot of inventory. And also, the demand was just very bad. Likewise, for smartphones, it didn't grow because you're talking about a 1.2 billion market or 1.2, 1.3 billion market, but it didn't contract. But this last 2 years is contracting. So basically, the end demand for consumer electronics, there was a lot of pull forward demand. So the demand they wanted in the last 4 years all went into during the pandemic years. So that's why you're having this decline in end demand. The table on the right hand side is basically foundry capex. This is what people like TSMC, and this is important because the chart on the right is where companies like UMS, your AEM, this is where the demand comes from. This is the 119 billion that you see, because their customers will intend order equipment for them because Singapore is quite heavy on semiconductor equipment. But you can see the demand was really strong during the pandemic years. Again, from 77, it doubled to 133 over 3 years. Then now it's going to drop back down into 2023. So one of the reasons semiconductor equipment is coming down is because memory prices just collapse, and also China, because of this whole ban in selling equipment to China. Some of these guys are losing, I don't know, 1-2 billion, couple 100 million, the equipment makers. So that also carve out maybe a rough number. I mean, it's not exact, but maybe 10, 15 to even 20% of their demand. So that is also, so memory and China really hurt semiconductor equipment demand, and that will flow to like UMS and EM and so forth. Okay, the next one is on telcos. I think we always show this chart. So if you own a telco stock from 2008 to 2016, those were the happy days because there was no competition. Everybody had to use SMS. Everybody had to use international IDD. So there was a fat margins there. Then, of course, we had TPG coming in, the fourth operator, then WhatsApp. I mean, nobody used SMS anymore. So then after that, the last 2 years has been the roaming revenue collapse. So we did have a question. I mean, let's preempt why StarHub. So one of the reasons is that actually roaming is very good for telcos. I think we estimate roaming could be maybe 40 to even 50% of StarHub's profit, because roaming is pure profit. There's no cost. No, like we mentioned before, if a StarHub customer go to Malaysia, it's pure profit. They just share with the operator there, and it's pure profit. So, but the reason why StarHub is underperforming is because they're going to spend almost 300 million to revamp their whole, a lot of the back end system, the IT system, to try to lower down the cost. Because in the end, for telcos, after you can see from this chart, after 20 years, it's still selling a free handset and with mobile service. So after 20 years, it's probably the same product. So it's a really matured industry, and that's why StarHub had to go through this major revamp of cost and so forth. So that's why the share price is like 30% below pre-pandemic. We still like Singtel because in emerging markets, they're performing better. The most important is Bharti in India, and that is still growing. I think EBITDA about 20%. So that we still like Singtel compared to StarHub in the near term.
Hi, I think there's a slight technical issue now. Just give us a short while. I think we'll wait for Paul to just come back. Yeah, so there's nothing wrong. I think he just dropped out. Thanks.
Yeah. So sorry for the disruption there. I'm not sure why it's hardly happened. Okay, so one of the reasons why, let me just a last point. One of the reasons why you can see the order books for SEM and Keppel Corp has jumped so much is because of the red line that you see here. Because the all capex has recovered very strongly. This is 126 billion. So this is the amount of capex, your BP Shell. So that bounced 40% to 176 billion. I'll move on to the stock picks again. Really sorry for the technical issue there. So in terms of, so this is our model portfolio. We try not to make too many changes, maybe one a quarter. So what we did was we took out Singtel and we added Prime. I think we got a lot of, I would say bordering on complaints of why we picked Prime, but I guess one of the reasons is because it's down 50%, but thankfully, I think Darren's going to answer any difficult questions you all have on Prime. So I'll leave it to that. Our performance, again, in terms of performance, what didn't do well for us was a lot of the small cap names, Del Monte and so forth, but we still like them. This is just the rough performance. Again, you may not, this is just an illustration. You may not be able to replicate the performance because this is a monthly rebalancing brokerage cost. But of course, we also do not include dividends into the way we measure this. But you can say that in conclusion, if I was the fund manager and I only gave minus 0.5% performance for 2022, the client would just say that he would have made more money sitting on his hands. So it was no point putting money with fund managers, since you could have just park money and earn like 3-4% interest rate, or park with the ETF and earn 4% return. I'll hand over to Glenn for the banking sector.
Thanks, Paul. So for the banking sector, we have done this table for showing the driven metrics for all three local banks, namely DBS, OCBC, and UOB, for their third quarter figures. So if you look at the top red box there, you can see that NIM growth was very significant in the third quarter, ranging from 40 basis points up all the way to 54 basis points. And this also flowed down to their net interest income. And all the banks are hovering around 40% growth, year-on-year growth. And this also flowed through to their PATMI. And this is one of the highest growth that the banks have seen, is upwards of 30%. So all of the three banks, we like the DBS and OCBC the most. We prefer DBS, and it's mainly due to the high CASA ratio of 60%. As seen from this, the bottom red box here, they have the highest amongst the three local banks. So what does it mean with a high CASA ratio? So with a high CASA ratio, the positive impact from the rising interest rates will be most felt by DBS. And this would translate directly into their NIMs, net interest income, as well as their PATMI. So DBS's business momentum is also strong. And despite the economic uncertainties from the macroeconomic factors such as slower growth, higher inflation, as well as supply chain disruptions, their loans and transaction pipelines are expected to be strong. The management have also said that stress tests of vulnerable sectors and countries have revealed no imminent areas of concern. So we maintain a buy on DBS with an unchanged target price of $41.60. We also prefer OCBC, and it's due to the upside of 21% to our target price. And furthermore, OCBC is currently also still trading the cheapest amongst the three local banks. OCBC will also be a beneficiary of the rising interest rates with a CASA ratio of 56%. So look at this bottom red box again. It is higher than UOB's CASA ratio of 50% and comparable to DBS's CASA ratio of 60%. There's also potential for higher dividends from OCBC due to its higher CET1 ratio, or Common Equity Tier 1, and this right above the CASA ratio. You can see that their CET1 ratio is the highest amongst the three banks at 14.4%. DBS is at 13.8%, and UOB is at 12.8%. We maintain a buy on OCBC with an unchanged target price of $14.22. So lastly, regarding the bank's exposure to China, at this the bottom column here, the last row, sorry, the three banks to China exposure to China remains small at less than 10% of total exposure, and DBS reporting that they have 14% of total loans, or 62 billion Sing dollars for the first half of 2022, while OCBC has 11%, or 34 billion Sing dollars for the third quarter, while UOB has 5%, or 23 billion Sing dollars in China for third quarter of 2022. So a majority of these customers include mainly their domestic and policy banks, the top tier state-owned entities, as well as large local corporates and foreign investment enterprises. And the bank's exposure to corporate real estate loans in China remains minimal. So a recent increase in UOB share price in the fourth quarter of 2022, as Paul mentioned earlier, might be because they have the lowest exposure to China, and this is at 5% of their total loans. However, with the recent reopening of China, the DBS and OCBC's higher exposure to China might actually pay off, and they should be able to add to their growth moving forward. So moving on to the next slide, we'll be moving on to SGX. So for SGX, we'll be taking a look at these two charts here, and this basically maps out their volumes. So for the left side, it's their securities volume, and it shows that it's trending downwards with their first half FY23 securities daily average volume, or the SDAV. It's down 8% year on year, and this is mainly due to the market sentiment remaining subdued due to the macroeconomic factors. And the volumes also moderated from a record year in FY22. However, their derivatives volume is trending upwards, and this is the right chart here, with their first half FY23 derivatives average volume, daily average volume, or their DDAV for short, is up 11.2% year on year. And as the market volatility continues to rise, the derivatives volume can climb for the rest of FY23. Secondly, we also expect the treasury income to rise in FY23. And the treasury income actually dipped in FY21 as well as FY22. And this was mainly due to the low interest rate environment. However, we do expect a rebound in the treasury income in FY23 by at least 8%. So based on historical data, SGX's treasury income, it lags behind the Fed funds rates, as a majority of their collateral balances, which total 13.9 billion for their FY22, are placed in fixed deposits with the tenure spread out, and certain deposits have not matured yet. Hence, the interest rates have not been refreshed, so it's not reflected into the treasury income. But nonetheless, moving to FY23, we should expect that the treasury income will recover back to their pre-pandemic levels as they get placed into higher interest fixed deposits. So for context, in FY20, so this is pre-COVID, SGX earned a yield of 98 basis points on collateral balances when the Fed fund rate peaked at 2.5%. And lastly, SGX's derivatives pricing is also reaching new highs, with their equity, currency, and commodities derivatives average clearing fee per contract reaching a new high of $1.62 in the first quarter of FY23. And this is 12% higher year on year and 7% higher than FY22's average clearing fee of $1.51. This uptick in derivatives pricing is mainly due to the product mix of the derivatives being traded. So this is quite encouraging, and we should see that the derivatives fee will continue to trend upwards. However, their securities average clearing fee per contract of 2.58 basis points in the first quarter was only marginally higher than FY22's average clearing fee of 2.56 basis points. We should also expect this to maintain at these levels going into FY23, into the full year of FY23. So although as I earlier said, their DDAV increase, volume increase is offset by the SDAV decline, so it resulted in a rather flat growth in volume. The derivatives pricing increase as well as the treasury income recovery will remain as the key growth drivers for SGX and will be able to boost their growth and bottom line. We maintain a buy with an unchanged target price of $11.71 for SGX. So that's all I have. I'll now hand it over to Darren. Thank you.
Thanks, Glenn. So for the REITs, we have two main topics. One of it is CapitaLand Ascott Trust for the strong recovery in REPA and tourism. And definitely the reopening of China, that would be a big step of growth for Ascott, as historically more than 10% of the international tourists are from China. So as you can see, on the right hand side of the chart is the portfolio RevPAR. Right now it's at $132 Sing dollars. It grew year on year from 70, so that is almost a 100% growth in RevPAR. So we really can see the strong recovery in RevPAR for Ascott. And we picked Ascott because it's also of its diversification in a geographical presence and as well as their steady income stream. Right now they have, as of third quarter 22, they have 56% of their income that they receive from stable income sources, mainly the master leases and the management contracts with a minimum guaranteed income, as well as the longer stay properties. 44% of their income in third quarter is from growth income, which will get the income from the recovery from the strong recovery from the international travel. Going forward, Ascott also has intention to have 25% to 30% of their properties in longer stay accommodation. So this will help in any weakening macroeconomic conditions where they have a stable base of income and the growth comes from the growth income from the recovery in travel. So we think going forward in 2023, macroeconomic conditions are not too favorable. So we like Ascott for these reasons, stable income. And definitely, like I mentioned before, the recovery in China, that will help to benefit the top line in Ascott as well. So with that, we have accumulate a rating on Ascott with a target price of 1.13 Singapore dollars, and Ascott has a dividend yield of 5.4%. Next slide, please. So for Prime US REIT, I see a lot of comments in the Q&A regarding Prime. So I think I'll answer probably one of it is upvoted by 6 people. So before I get to that, we like Prime US REIT because of its valuations and its resilient portfolio with a high dividend yield. So on the right side, you see Prime has a tenant sector diversification, which is quite diversified. The biggest tenant sector is finance, and 73% of their tenants are in established and growth STEM or TEMI sectors. So tenant-wise, they are very diversified. And on the interest rate hedge exposure, they are 83% hedged with no expiries in 2024. So they are relatively protected until 2024 in this rising interest rate environment. We also like Prime because they have 10 previous positive quarters of positive rental reversions, and their leasing activity in the most recent quarter, the third quarter, was almost double the first half's leasing activity. So contrary to what you see in the news, actually Prime's leasing activity is quite strong, and they have a good track record of positive rental reversions. In fact, the positive rental reversion in the third quarter was 10.4%. So I'll answer this question. Darren, is Prime REIT's yield of 10%, more than 10% sustainable? Yeah, actually, we think it is sustainable at more than 10% because right now the price has just dropped way too much, and now it's trading at 17.5% dividend yield. So if you ask me whether more than 10% is sustainable, yes, we think so. And the main issue is probably the occupancy. Right now it's 89.6%. And then despite this quarter, they had some non-renewals, which were previously already mentioned. They managed to release, backfill some of the spaces of the other vacant properties, which resulted in an occupancy to remain flat this quarter at 89.6%. So just to explain why we think Prime is a value play, right now it's trading at 45 times price to book. So if we put it into context, like let's say we buy a Singapore property, like a condo at 1 million, you're only paying 450,000 for it. So that's one of the reasons we think Prime is good, a good pick for us. So with that, we have a buy rating on Prime with a target price of 88 cents. That is about one times price to book, and with a dividend yield of 17.5%. So that's all for me. For Prime US REIT, I'll hand over to Terence.
Yeah, thanks, Darren. So for Keppel Corporation, the recently the Keppel shareholders already passed the EGM for the divestment of the O&M REIT to Sembcorp Marine. For us, there are two implications with the passing of the EGM. Firstly, that clears the hurdle for Keppel to divest their O&M unit to Sembcorp Marine. Secondly, even if in a worst case scenario where the Sembcorp Marine transaction does not occur, Keppel Corporation can actually, the second part of the EGM actually passed for them to actually continue their divestment of Ascott Co. So just to recap, Ascott Co is actually the legacy REITs that they hold. And in the last few months, Keppel has actually been very active in monetizing their legacy REITs. So now the difference now is that the two transactions are not interlinked and are not interdependent on each other to take place. So they are independent of each other. So even in the worst case scenario where we take like Sam Marine shareholders actually don't support the deal, the legacy REITs are actually already at this process being monetized independently of the outcome of the Sam Marine EGM vote. Like what Paul mentioned earlier in the macro slides as well, the Keppel O&M's order book has also been boosted very strongly by the spike in capex spending by the oil majors. You can see here on the chart here on your left-hand side, the Keppel O&M order book has been boosted by the awarding of the FPSO contracts. Their current latest order book is at $11.8 billion, which is higher than the last 7 years. But for us, the key thing we are watching, obviously, having said all this, is the final hurdle to the divestment of the Sembcorp Marine, the O&M business to Sembcorp Marine. Overall, there's a positive pro forma EPS impact from the divestment of Keppel O&M, and it's just one more hurdle. I expect the Sembcorp Marine EGM to take place in January. That's the guidance from them. And the successful divestment of the O&M business will see a re-rating of Keppel Corp. So with that, we have a buy rating on Keppel with a target price of $8.95. In our next slide on BRC Asia. BRC Asia is just cheap. So for us, BRC Asia is a proxy of the construction industry with a 2/3 market share, more than 2/3 market share of the reinforced steel market share. They are like a market leader and also clear proxy of the construction recovery. They are trading at 5 times FY23 earnings, which is what we are forecasting, and 9.8% financial year 23 dividend yield. So for us, if you look at the historical, their latest year financials, the net profit was up 81% despite all the heightened safety period that has been imposed. Net margins has improved. The other tailwind for them is that the steel prices which shot up in 2022 has also moderated. So that has seen a reversal of the onerous contracts which they booked in their books, and that has also boosted their profitability. So for BRC Asia is not a difficult call. Other than the low PE, the dividend yield also supports the holding of the counter. So we have a buy on BRC Asia with a target price of $2.30. Yeah, our next slide is on city developments. So for city developments, there are two main, for us, there are two main things. The first is the property development continues to be a very resilient part of their business. The second tailwind for city developments is the hospitality segment, which will continue to support profit for FY23. So we'll talk about the hospitality slightly later. But right now, city developments have more than 1,800 units in their launch pipeline, which in our view elevates the land bank replenishment worry, because land bank prices are very high now. And so for a lot of the developers, they are a lot more cautious in terms of replenishing this land bank that they have because of this high land bank price. So they are sitting on the sidelines. But for city developments, because they are the largest developer, they have a lot of units. That means that they can be a bit more patient. They don't need to rush to replenish their land bank for FY23. For FY23, they have a steady pipeline of launch. Some of the launch that we expect to see is the Bukit Batok launch very close to Kopan Grand, the Jalan Tembusu, and the Fuji Xerox building that they're going to launch. But of course, beyond FY23, then there'll be a little bit more worry, because then they will need to replenish their land bank. Because if you look at this table here at the bottom, you can see that most of their inventory is also close to fully sold already. The average is about 90% sold. So that's also something that they are watching very closely to try to ensure that they have enough inventory and enough pipeline. In my last slide on the hospitality segment. Yeah. So thanks. So the ref for city developments, the hospitality segment is the one that is driving their profit right now. The RevPAR continues to increase, driven by hospitality rebound in Singapore, Europe, and US, like what we mentioned. So the hospitality segment is the steady part for them. So we have a accumulate rating on city developments with a target price of $8.86. This $8.86 is a 35% discount to our RNAV of about $13. But if we look at the discount to city development's own computer RNAV, because they take into account some hospitality gains in there as well, the RNAV is $16. So it's about 50% discount to their own RNAV. So we think it's we have an accumulate rating on city developments. So that's all for me for city developments. I hand back the time to Paul.
Yeah, thanks, Darren. So coming close to the end of this session, so another four more slides for me. So the next one to be like is Del Monte Pacific. So for those who don't know, Del Monte has like 80-90% market share in Philippines for juices and canned food. Likewise, they have like 20+% market share in the US. So this is a table of their net profit. For us, we think the journey is just beginning. So just to take a step back, so Del Monte Pacific, the Philippines company, they acquired Del Monte Foods, just to confuse everyone, in the US for $1.7 billion in 2014. And it took them almost 6 years to restructure, to close factories, because the old US Del Monte, the US that they acquired, wasn't focused on branded. It was more like a manufacturer, house brands for everyone. So they had to close factories, and then they had to change the CEO halfway through. After 2-3 years, they realized that probably not the right CEO. Then the new CEO came in and then had to launch a lot of new products, for food cups and a lot of product extensions and new channels. So that's why you see the turnaround meaningfully only happen in FY23 and also FY22. So we still like it. The big overhang why the share is because of the debt. So their debt jumped to almost was around 2 billion. And one of the reasons the debt went up is because they built up a lot of inventory this most recent quarter because of the coming festive season, of course, because of higher raw material costs. Their margins were at record levels because they managed to raise prices. And also what is doing well for them in the US is because of inflation. Most people are dining in the home rather than dining out. So that's why we still think they do well. The big catalyst, if it does happen, I mean, no one is clear, if they do go ahead with the listing of the US, then that can help the de-gearing and kind of remove a bit of the overhang. But having said that, this stock we think is trading, I mean, we are the only analyst covering anyway, so you have to rely on our forecast. So it's like 4 times PE and 8% dividend yield. So that's very low for a consumer name. For Comfort, yeah, I know it's Comfort again. Why is it not doing well? Okay, I already read everyone's mind, but we still like this stock. So let me explain what happened, why the share price didn't do well. It's still 50% below pre-pandemic 2019. So third quarter was supposed to be the quarter. It's like we took the champagne bottle out, really chilled the champagne ready to pop, because that was the quarter where the results supposed to be very good. But what happened is you can see that Singapore numbers are very strong. You can see from here, year to date, Singapore did exceptionally well, but the UK, Australia, and China was the one that pulled the numbers down. China, because they had to give taxi rebates because of the pandemic. So China, they have the taxi operations, they still have to give rebate. So I think it's almost 15 million. So that hurt the China numbers. And what happened more meaningfully was in the UK, because in the UK, their contracts are linked to CPI. So although UK CPI is up 10%, but you take at least a year for it to reprice, and they had to take on a lot of additional costs, namely from the bus drivers. And I think, as you know from all the strikes in the UK, so as a result of that, the third quarter results didn't do well. So that's why, although it was our preferred reopening stock, since the reopening, that it hasn't performed well, we still like the stock because we think the cash flows are doing well. And also, you're still going to get a big growth in Singapore, like we see here in the third quarter. And it just takes time for the overseas operations to unwind, because it takes anniversary. So every bus contract, you take 1 year to reprice it to the CPI, to reprice everything upwards to CPI. The last one for me is just our HRnet. Again, we still like it. They spend like 100 million to buy back shares, to give dividends, and the share price is still flat. But anyway, we like it because one of the unique things is probably has we think one of the highest ROE stocks out there. So you can see that if you adjust the ROE, we think this stock probably has a 200% ROE. Of course, everyone will be complaining why is that so? It's been officially 16%, but because they have excess cash of 300 million. So if you take that cash, of course, some will say, why do you need to take out? But they already have 200 million of trade debtors that they use to help fund the payment. So HRnet is one of the largest recruiters in Asia Pac with 700. And the reason why they can earn so high is because there's a lot of barriers to scale. So the two parts of the business, one is flexible hiring part-time. So that use a lot of capital. So they use 200 million to build that business. Then the other part, which is the permanent, like headhunting business, that very little capital, but barriers of entry are low. But when you have 700 recruiters, that gives you the skill. Then you can work with the larger clients, and the recruiters will want to join you. And they are across 16 cities. So the reopening of China will also help them because they have presence in Taiwan, China, and Hong Kong, Malaysia. 40% of their earnings is actually outside. Okay, I would just go back to the conclusions. So this is my last slide. So the conclusions, we think that the macro conditions in 2023 is a bit of a, we call it mini Goldilocks or Goldilocks light. That means it's going to be too hot or too cold. We just right for the market, but it won't be robust. So equities, we don't think global equities is going to have a runaway because there isn't much growth out there, maybe apart from China. We don't think that if there is a recession, the US will be shallow because jobs and so forth. I think we mentioned that. And there's no major deleveraging. The only deleveraging was probably the collapse in cryptocurrency, about 2 trillion. But that's confined to just probably it's a very shallow. It didn't go into the real economy like banks. The Singapore economy is in great shape, especially with China reopening. And the sectors we favor, the banks, consumer, and REITs. Okay, this is our analyst team. So we go to Q&A. This is our QR code. So this is our new P3 community. And if you do have if you do have questions, so most of the questions that we don't answer or we won't answer, we will just post it in our community. So I'm going to leave this on for a while, and we will just try to answer some of the questions before we end it at 12. So thanks everyone for staying back. So let me just, okay, Roshan, over to you.
Yeah, I just want to say thanks, Paul and the team, for the insightful presentation. Just like you said, now it's the Q&A session. Take it away, Paul, please. Thanks.
Okay, thanks, Roshan. Yeah. So we'll just run through the most upvoted. So I will do the first two, then I'll do the first three, then I hand it to first four. There's so many for me, but anyway, can comments on Comfort and Delgro? The reopening has occurred, including China, but both are trading at prices closer to the last GFC. What is happening? Yeah, I want to run back to the post GFC, but if you look at 2019, that means just before the pandemic, I think StarHub is down 30%, Comfort is down 50%. So for Comfort is, again, number one, the results for the third quarter wasn't that great. And number two, investors are still very negative, I think, on the taxi business. So, okay, the only one thing about taxi that is the negative is the fleet is coming down. So the fleet is probably declining about 5-6% a year. So of course, this negative is going to be a headwind for revenues. But what is offsetting is the growth in traffic, and of course, the change in the model to move towards more commission-based. So this will help them grow the business, because if more of the business comes through app bookings, so that will help the business. Of course, China will be helpful. At least you won't have like maybe 15 million of rebates. So if China reopens, that is also a positive. For StarHub, it's a bit clearer because I think next year the numbers will still be very bad. I'm sorry, 2023 results will still be bad because they've already highlighted they're going to spend almost, I think, 100 million in capex, in OPEX, and probably another 30 million in capex to revamp the whole business. They're trying to gap down their cost structure. of course, part of it is also on the EPL. They bought the rights to EPL. So there's also another burden to cost. If not for that, this would have been a really good rebound stock because of the whole roaming. And the other thing is that eventually there's going to be some consolidation in the mobile operators. Whether is it from 4 to 3 to maybe 1 plus 1 plus maybe 2 plus 1 or whatsoever. But we think consolidation will happen because I don't think TPG can exist in its existing form, especially if they're going to give free roaming, which is the best part of the business. Move on to the next one. Recent report I read, many investors are cashing out of Southeast Asia, Singapore to Hong Kong, China. How do you see the prospects of China, Hong Kong next 2 quarters? I think my colleague Louis Wong will give a better outlook for China and Hong Kong, but obviously that will be where the most momentum is. I don't think, although Yanlord, a pure China company, is doing very well as a property, but I don't think people are going to come to Singapore, all the way to Singapore to get China exposure. So obviously, or even go buy Yang Zhejiang Financial for China exposure, rather just go buy in Hong Kong or China directly. So as a result of that, we think the momentum is there. I mean, there is the reopening. There's only one direction. It's just going to reopen, growth or rebound back. So that is true. I think momentum is definitely going to be near term. Next 2 quarters is going to be China, Hong Kong, and even the rebound. If I'm not mistaken, 2022 they are still down about 20-odd%. Yeah, but do dial into Louis Wong's Hong Kong briefing, then they will give you more data, more update on that. I'll take 2 more, then I will move on to Darren. Any further info on Yang Zhejiang bankruptcy petition? Should we cut loss now? Okay, this news came out only in the media, and just a bit of caveat. The company putting up this petition is from Liberia. So I do not know anyone from Liberia or not much of a Liberia, but if it comes from a US or even a company from China, probably there will be a stronger merit to this legislation, to this so-called petition. So do note, I'm just taking out from the media, is the Liberian company. So I'm not sure how much merit you want to put into that. But having said that, there will be pressure, we think, on their. Firstly, the share price has done really well, number one. Then number two, with freight rates, I think we showed you earlier, with container freight rates coming down and even bulk shipping rates also not climbing up that strongly, we are a bit concerned of the ability to grow the order books. In general, very broadly, we don't cover the stock. The market has already run because the market is pricing in a big LNG contract from them. They do LNG, but it's a smaller version. If they do get a large LNG vessel contract, then maybe there could be a time where you buy a rumor and sell on a fact. So again, so that is my only concern, that the order book might dwindle, and the one last run will be probably a big LNG, and then that could be, I mean, that's our own views, and do note that we don't cover. I'll take on this last one on Olam, then we'll move on to Darren. Hi Paul, as Olam is hiving off his Olam Agri unit, what would be the likely valuation of his unit? Based on the latest results, Olam is doing well. Okay, excuse me. So we did talk about it. We don't cover the stock, but we did have in our weekly updates, we did have a presentation. So just just trying to recollect, but I think if you add, so there's Olam, the listed company that we all know, then they have Olam Agri and Olam Food Ingredients. So they sold Olam Agri to a Saudi, to a Middle Eastern company, and then now they want to list it. So on paper, if you combine both, it should be, from recollection, maybe 2 times or even 3 times larger, at least, than the current market cap. But having said that, we're a bit skeptical. We're not sure how you're going to list Olam Agri, because if I'm an investor here, why would I want to buy Olam Agri? Because we know if Olam Agri really gets listed, Olam is going to run. So I might as well just buy Olam, and you get 2 cuts of the re-rating for Olam, the listed here, the current listed entity here, from the listing of Olam Agri and also the upcoming possible listing of Olam Food, which is even bigger than Olam Agri. So that one I'm not sure, because it doesn't mean that everyone that applies for IPO is going to get it. I think we saw what happened to Thai Beverage. They also wanted to get IPO, but I think nothing happened because probably we got valuation issues. But again, my worry is whether the listing here can work or not. Because if I'm an investor, I just unless you give me in specie, so unless they do a IPO in specie, then that could help the share price. So if that happens, then that could help. But again, you still need to raise third-party money. So that one, I'm not sure how they're going to, unless it's just pure capital raising, like what they did for Yang Zhejiang. That means that's dividend out whatever shares. That might help Olam Food. But the main one will be Olam Food. If they list it in UK, then they'll get fresh money. So that would be the bigger catalyst. But in conclusion, they're right. I mean, if they list both, you're talking a market cap of 2 to 3 times, especially if they give shares. That means those who hold Olam shares will get these new shares. Then of course it's like a free ride. You buy $1, then you list it, you're going to be $2 to $3. I will let Darren take the next question. Yeah, thanks.
Yeah, thanks, Paul. So I will pick some of the questions that are the most upvoted. I'll answer a few before I hand over to the rest of my colleagues. So the first one is, as US interest rates are expected to remain higher for longer, what is your view on the future of Singapore listed US office REITs like Manulife Prime and Keppel? What are they likely to do to prevent breaching their covenants? Yeah, so first of all, because of the US interest rates, they're expected to remain higher for longer. As you know, over the past week, we saw all the none of the Fed officials, they saw a decrease in rates in 2023. So because of this, if rates remain about 5%, this will definitely affect them, the US office REITs, as they refinance their loans. But then we have to see their hedging ratio also and how long they are hedged for. So like for Prime, they are hedged until further than 2024. So we think they are relatively, the impact of rising interest rates, they are relatively mitigated, the impact. So the next question, what are they likely to do to prevent breaching their covenants? I think this is probably in relation to the devaluation of their assets that Manulife wrote a note about at the end of last year. So for Manulife, they had a 10.9% devaluation of their property as of end 2022. But then most of it is due to one asset, which is the Figura, which was down 33%. The rest were about 2 to 12% devaluation. So based on exactly what are they likely to do to prevent breaching the covenants? First of all, if the ICR dips below 2.5%, which is the MAS regulation to have your leverage up to 50%. So if it dips below 2.5% because of the devaluation of your assets, it is not considered to have, you are not considered to have breached your covenant. But because of that, you are not allowed to take on any more further borrowings. But refinancing in this case, like refinancing your existing loans, is not considered as taking on additional borrowings. So you still can refinance your existing loans. So for them, because of the devaluation of assets, they have not exactly breached their covenants. So what the REITs will most likely do, they will prioritize, first of all, they'll prioritize divesting their assets to bring their leverage ratios lower, as well as the ICRs, to improve the ICRs. But this will be their priority definitely, because the other method to do it is probably to raise more equity. But then at these current valuations, like they're trading at 50% over discount to their book values, is almost definitely not wise to raise any equities at these prices. So there is a further question to that. Allow me to add, what happened to Manulife? Is it likely to happen to Prime US REIT as well? Yes, we think that the devaluation will definitely affect Prime, but maybe to a smaller extent, like probably 3 to 7% in the mid-single digits devaluation that we anticipate for Prime's properties. But then, having said that, even if they have let's say a 5% devaluation of their properties, they are trading at 0.45 times book value. So it's still a value play for us. Okay, so the next question is, hi, understand there seems to be some structural changes in the office scene in US, where workers are not really coming back to office and many of the office spaces are left vacant. the situation seems quite bad. Even Manulife US REIT is trying to convert their office buildings for other users such as residential. Wouldn't Prime suffer the same fate? Thanks. Yeah, so you are right to a certain extent, because actually Manulife US REIT, they did come out and say that they are planning to hotelize their portfolio. It's not exactly converting their office buildings to other users to make it a hotel or residential. It just means that when you go to work, the building looks like a hotel. Like when you go to work every day, you have a nice lobby, then you have like a rooftop bar and a nice pantry area, etc. It's not to make it a hotel or a residential asset. It's just to make the building look nicer and more appealing for office workers to go back to work every day. Yeah, so that is that on the not so much converting to residential. So I also spoke to one of the US REITs. Also, they mentioned that a lot of tenants you see a lot of tenants that are retrenching, like a lot of big tech names, especially they are like lowering their headcount by 10%, etc. So some of these companies are doing is they're making, because they don't want to have this report of, oh, so and so is reducing their headcount by 10%. So they are using this return to office as a way to kind of quietly retrench people. Like let's say if your people, like your employee, you don't go to work, and then the next day they'll just send an email say, oh, you don't need to come back anymore. Something along those lines. So by doing it this way, they don't really have to report that, oh, they're downsizing by 10%, which will look very bad on the news. So this is like a quiet way to kind of retrench workers. So this is also because the labor market is also kind of tightening in that sense, and we do see people actually going back to office in the US. But then of course we see the companies also, they are considering and they are considering their space needs and whether they need so much space, and we are seeing a flight to quality, like higher nicer buildings and better amenities around, etc. We are seeing higher demand there as compared to like the class B, grade B buildings, which are the ones that are really struggling. So the higher trophy assets and class A are not so much being affected. Yeah, I think there's one question on the outlook for Frasers Hospitality Trust and Manulife US REIT. Yeah, so Manulife US REIT, I think I have spoke quite a bit about it already, so I'll just skip that. And for Frasers Hospitality Trust, yeah, Frasers Hospitality Trust, from what I see, their ICR is actually 2.6 times. So it is dangerously low to the 2.5 times where you can have your gearing up to 50%. And of course, they'll benefit from the reopening play, and as they are from hospitality sector and reopening of China. But then for them, I think the privatization this year that Fraser Property tried to privatize FHT, that was kind of a bummer for them. So yeah, we don't cover FHT, so yeah, I don't really have much comments on that as well. But they definitely will benefit from the reopening play, other than the fact that their ICR is dangerously close to 2.5 times. And I think with that, I'll hand over the rest of the time to my colleagues. Thanks.
Terence, you want to take the SIA and SETs also at the bottom?
Okay, let me take the SIE question. Prospect of SIE. No, we don't have any coverage on SIE, but based on their last financial results, they actually turned profitable, and they started to distribute dividends. So we think that the in terms of the outlook for SIE remains positive, and it will likely be supported by the major tailwind for SIE will be the loosening of COVID restrictions in China. Yeah. Sorry, I can't seem to take this out. Because of time constraints, I'll probably just take another like 2 or 3 top voted questions. There are a few questions here. Let's take 2 first. Can you share your view on SET's earnings going forward after digesting the acquisition of the Dutch air cargo company, will the results be impacted by sharply higher financing costs and acquisition fees? Yeah, so the higher financing costs and acquisition fees will impact their earnings. But overall, when they put everything together, the pro forma acquisition will see the sets see accretion in terms of their earnings. So the acquisition of WFS, Worldwide Flight Services, will actually see their earnings improve. But if you want to look at how their earnings will go going forward, that depends on two things. Firstly, other than the air cargo volume for 2023 being dependent on that, the second thing is whether they're able to realize the synergies that they say. So they have a lot of revenue synergies that they say they want to achieve in the next the near to mid-term. So for us, that's one area that we are watching very closely, whether they are able to achieve those revenue synergies. And now it's just really too early to tell. But management is confident. They've listed out a few activities which they think they can realize revenue and a bit of cost synergies from. But we will watch this over time. But in terms of our forecast, we didn't compute all these $100 million of synergies that they say they will achieve in the next 3 to 5 years. We didn't put that into our forecast. We still have an accumulate rating, but we didn't put that in. But we're just if so, all these synergies represent an upside to our earnings. So the next question, with the massive overhang of the REITs shares and poor earnings, will the earnings, sorry, the question disappeared. Let me just go. Will the share dive below the REITs price? So SETS just released last Tuesday the commencement of the EGM, expected to be held on the 18th of Jan. So shareholders will vote on whether they want the acquisition. So assuming the acquisition goes through and they do the rights, then we think it will remove one of the overhang of what the rights price will be and the outcome of this. The shares dive below the rights price. That again depends, but we think there's some tailwind at this moment in terms of because of China's reopening, and SETS along with SIA Engineering and SIA have been ramping up on their hiring in the last 6 months because they actually already anticipate that they need to be ready for this reopening. So because of this they are ready for the traffic flow. So if all things equal, we are actually positive on SETS because of the loosening of the restrictions. Next question. Hi Paul, Terence. As for Keppel FY22 results due to be released in a month's time, do you anticipate its results be better year on year, excluding KOM? Yeah, so that's a good question. Excluding KOM, we actually expect the results to be weaker. So it's quite ironic, right? Because KOM has always been the one dragging their financials. But the one dragging their financials this time round is actually their property development business in China. That we expect to be down by about 20% for financial year 22 because of the COVID restrictions there. But FY22 will still include KOM. So as a whole, we still expect Keppel's FY22 results to be strong. Because of time, I think I'll just stop here and hand back the time to Paul to see if there's anything else.
Yeah. Okay. Thanks, Sharon. So most of the questions that we can't answer. Okay. There's one more question on Comfort. You've been giving good review many times. The share price don't move. So this quarter we're just looking for good dividends from them because the reason is because one of the reasons why we still like Comfort was during the whole pandemic, their balance sheet actually strengthened. They actually generated almost 900 million of free cash flow. So we think they're going to have to pay back because everyone's going to demand since the share price didn't do well, right? So they're going to probably everyone's going to demand higher dividends, and that should help the share price when the results are out. There's still quite a number. We won't run through everything, but because it's coming to 12, so I'd like to thank everyone. We will post most of those rather than send emails in the past. We will post most of the answers to the questions that you have in our P3 community. So do look out for it over there. Because in the P3 community, that's where if you ask any questions, especially technical, you can help. So with that, I would like to thank everyone for your time and all your questions, and hand it back to Roshan.